When you think of investment banking, images of sharp suits, high-stakes deals, and eye-watering salaries are likely what come to mind. And for good reason. Investment banking analysts are among some of the highest paid professionals straight out of college or university, earning impressive salaries and bonuses that far exceed those their peers in other industries are receiving. But beneath the surface of this cash-rich lifestyle lies a different reality, one where wealth accumulation is often delayed and the road to financial security is more complicated than it appears. So with that, let's dive into the life of an investment banking analyst, exploring how this career path can lead to being cash-rich but asset poor, and what that means for long-term financial well-being. The allure of the big paycheck. There's no denying it, the money in investment banking is good, really good. For many fresh graduates, the six-figure starting salary is a huge draw, especially when coupled with the prospect of year-end bonuses that can sometimes double their base salary. It's not uncommon for first-year analysts at top-tier investment banks to take home over $150,000 or more, a figure that dwarfs the earnings of most of the other entry-level jobs across industries. But this high income comes at a cost. And it's not just the long hours and high-pressure environment. The very structure of investment banking analysts' compensation can contribute to a paradoxical financial situation, one where cash flows in abundantly, but actual wealth in the form of assets lags behind. Living the high life, lifestyle inflation. With great income comes great temptation. For many young analysts, the sudden influx of cash can lead to lifestyle inflation, where expenses quickly rise to match or even exceed their income. The allure of living in a luxury apartment in a prime city location, dining at high-end restaurants and wearing designer clothes can be hard to resist, especially when surrounded by peers who are doing the same. The trap is obvious. The problem with lifestyle inflation is that it eats away at your ability to save and invest. When you're spending most, if not all, of your income on maintaining a lavish lifestyle, there's little left over to build real wealth. Even if you're earning a substantial salary, you can find yourself living paycheck to paycheck with little to show for it in terms of assets. The solution: it's crucial to resist the pressure to keep up with the Joneses, or in this case, your fellow analysts. By maintaining a more modest lifestyle and consciously keeping your expenses in check, you can free up a significant portion of your income to save and invest. Remember, the goal is not just to look rich, but to actually build wealth over time. Number 3, the reality of high taxation. So another factor that contributes to the cash-rich asset-poor conundrum is the high level of tax or taxation that comes with a large salary. In countries like the United States or the United Kingdom, where income taxes are progressive, those earning six-figure salaries are often subject to higher tax brackets. This means that a significant portion of your income is going straight to the government before it even hits your bank account. So when you factor in federal, state, and sometimes city taxes, plus other deductions like Social Security or National Health or Medicare or, whatever it might be, the amount of take-home pay can significantly be less than the headline salary figure. For investment banking analysts, this means that while they may be cash rich on paper, their ability to accumulate wealth is hampered by the higher tax burden. Tax strategies. So to mitigate the impact of taxes, it's important to take advantage of tax-efficient investment vehicles like 401ks, pension schemes, IRAs, and savings accounts. Contributing to these accounts can reduce your taxable income and allow your money to grow tax-free or tax-deferred, helping you build wealth more effectively over time. Number 4, delayed wealth building, the focus on income over assets. So in the early years of an investment banking career, the focus is often on maximizing income rather than building assets. This makes sense given the demands of the job and the relatively young age of most analysts. However, this focus on income can lead to a delay in wealth building, as analysts prioritize short-term earnings over long-term financial security. The pitfall is when you're earning a high income, it's easy to be complacent and assume that wealth will follow automatically. But income alone doesn't build wealth. What you do with that income does. If you're not actively investing and saving, you're missing out on the compounding growth that is key to building substantial wealth and assets over time. So to avoid this pitfall, it's essential to shift your mindset from just earning income to building wealth. This means creating a financial plan that includes saving a significant portion of your income, investing in a diversified portfolio, and setting long-term financial goals. By focusing on asset accumulation early on, you can set yourself up for financial security further down the road. Number 5, the golden handcuffs. So staying for the money, not for the passion. One of the most common reasons analysts stay in investment banking, despite the grueling hours and high stress, is the money. The promise of even higher pay as you progress from analyst to associate to vice president to managing director and so on can be incredibly enticing. However, this can also lead to a phenomenon or to the phenomenon known as golden handcuffs, where you're tied to a job you may not love simply because it pays so well. The dilemma is golden handcuffs can keep you in a role that's financially rewarding, but personally unfulfilling. While you're earning a substantial income, you may be sacrificing your well-being, work-life balance, and long-term happiness. Over time, this can lead to burnout and a sense of being trapped in a career that doesn't align with your passions or values. Breaking free. So if you find yourself in this situation, it's important to evaluate your long-term goals and priorities. Is the high income worth the toll it's taking on your life? Are there other career options or paths that you can pursue that provide financial stability in a similar way? Sometimes taking a step back to reassess your career can lead to a more balanced and rewarding life, even if it means a temporary reduction in income. Number 6, student loans, the hidden burden. So for many investment banking analysts, the high salary is a relief or a welcome relief after years of accumulating student debt. However, the reality is that student loans can be a significant financial burden even with a large income. Depending on the size of the loans and the interest rates, paying off student loan debt can take years, delaying the ability to save and invest. The challenge, so high student loan payments can eat into your disposable income, making it harder to build assets. While you might be earning a lot, a big chunk of that income is going towards debt repayment, leaving less room for saving and investing. Strategic repayment. All right, to manage student loans effectively, consider creating a repayment strategy that balances aggressive debt payoff with saving for the future. While it might be tempting to throw all your extra cash at your loans, it's also important to start investing early to take advantage of compounding growth. A balanced approach can help you reduce your debt while still building assets. 7, the importance of financial literacy. So one of the biggest challenges for young professionals, including investment banking analysts, is the lack of financial literacy. While you might be a whiz at financial modeling and analyzing company valuations, personal finance is a different ballgame. Without a solid understanding of how to manage your own money, it's easy to fall into the cash-rich, asset-poor trap. Most VPs, associates, managing directors are actually struggling on their personal finances as well. It's a common issue, and people think, just because you work in finance and banking, you got your personal finances in check. This couldn't be further from the truth. The gap. So financial literacy isn't taught in schools, and many young people and professionals enter the workforce without a clear understanding of budgeting, investing, or long-term financial planning. This knowledge gap can lead to poor financial decisions such as overspending, undersaving, or even failing to invest for the future. Taking control. So to avoid this, take the time to educate yourself on personal finance. There are plenty of resources available, from books to podcasts to online courses and financial advisors that you can access. Most firms offer you these services as well. The more you know about managing your money, the better equipped you'll be to make smart financial decisions that set you up for success over the long term. Last but not least, number 8, building real wealth, the road to asset accumulation. So how do you transition from being cash rich but asset poor to building real wealth? Well, it starts with a proactive approach to financial planning and a commitment to prioritizing long-term goals over short-term gratification. Budgeting and saving. So create a budget that allocates a significant portion of your income to savings and investments. This might mean making some sacrifices in the short term, but it will pay off in the long run. Aim to save around, say, at least 20 to 30% of your income, and consider automating savings to ensure consistency. Investing wisely. Don't let your money sit idle in a low interest savings account. Instead, invest in a diversified portfolio that includes stocks, bonds, maybe even some cryptocurrencies and other asset classes. The earlier you start investing, the more time your money has to grow through compounding. Setting financial goals. So define your financial goals, whether it's buying a home, retiring early, or building a robust emergency fund. Having clear goals will help you stay focused and motivated even when the temptation to spend is strong, and that's going to happen. Seeking professional advice. So if you're unsure where to start, consider working with a financial advisor who can help you create a personalized financial plan. A good advisor can provide you valuable insights, help you avoid common pitfalls, and keep you on track to achieve your goals. To wrap it all up, from cash rich to wealthy, being an investment banking analyst or any financial analyst early on in your career can be incredibly rewarding, both financially and personally. But it's important to recognize the potential pitfalls that come with a high income and take proactive steps to build real wealth. By avoiding lifestyle inflation, managing your taxes, focusing on asset accumulation, and prioritizing your financial literacy, you can escape the cash-rich, asset-poor trap and set yourself up for long-term financial success. Remember, true wealth isn't just about how much money you earn. It's about how much you keep, invest, and grow over time, as well as making sure you're wealthy in your personal endeavors and life. By making smart financial decisions early on in your career, you can build a solid foundation for a prosperous and fulfilling future. Thank you for making it to the end of the video. Check out the first link in the video description below for a free investment banking overview crash course, and I will see you in the next video. Peace.